National Energy Services Reunited, ticker NESR, completely crushed second quarter consensus on both the top and bottom lines.
Yeah.
Let's get right into the numbers.
Yeah, it was a massive print.
Revenue came in at a record $520.8 million. I mean, that is up 59.1% year over year.
Which is just staggering.
Right. And up 28.7% sequentially, just totally blowing past the street's $448.5 million estimate.
And the bottom line looked just as good.
Exactly. Adjusted EPS hit $0.44, easily beating the little $1.35 consensus. But look, it didn't stop at a backward-looking beat. Management raised guidance, establishing $2 billion in revenue as the new minimum objective for 2026.
Yeah, they essentially hit their previously stated run rate target, like 2 full quarters early.
And the market reaction was immediate and violent. The stock surged over 23% following the print, closed at $36, hit a new 52-week high, and pushed well past Wall Street's mean target of $33.
It really is an incredible quarter. And what is crucial for you to understand if you are analyzing the space as an investor is that this was not a story of aggressive cost-cutting.
Right. No accounting gimmicks here.
Exactly. No favorable accounting adjustments. This was pure, unadulterated top-line expansion. It was driven by extreme operational execution in what is arguably one of the most complex geopolitical environments on the planet right now.
Yeah, beating revenue estimates by over $72 million in a single quarter isn't a rounding error. That means their equipment utilization and their underlying market share are accelerating far faster than any model on the street predicted. Okay, let's unpack this.
Let's do it.
If revenue jumps almost 60% year over year, that kind of capital influx has to originate from very specific heavy-duty projects. Where exactly is this money coming from?
Looking at the segment data, the growth was heavily driven by Saudi Arabia. Specifically, we are looking at the rapid ramp-up of the Jafurah unconventional project.
Oh, the Jafurah Basin. That's Saudi Arabia's massive push into unconventional gas, right? Like their equivalent of a mega shale project.
That's exactly it. And to service that, NESR had 4 hydraulic fracturing fleets fully active throughout the entire quarter.
4 whole fleets.
Yeah, and management noted a 5th fleet is arriving in-country very soon. I mean, the sheer volume of that work pushed their production services segment revenue to $570.8 million for the first half of 2026.
Wow.
Meanwhile, drilling and evaluation services hit $354.6 million.
And, it wasn't just Saudi Arabia carrying a weight. I saw they had solid gains in Oman, Egypt, and North Africa, too.
Right. Broad-based regional growth.
Which is good because those gains completely offset the lower activity in Iraq, which remained a bit of a drag due to the ongoing regional disruptions there.
Yeah.
Though, to be fair to NESR, their exposure in Iraq is pretty limited compared to their global peers.
Yeah, that limited exposure is a structural advantage for them right now. But let's look at the broader regional dynamic. What's fascinating here is the intersection of their capital strategy and their operational posture. They made massive equipment investments early.
Yeah, I look at this Jafurah ramp-up, and management's early equipment purchases look like a brilliant counter-cyclical chess move.
It really was.
But I have to push back on this a little bit, because when we hear companies talk about market share gains during a crisis, they almost always point to their, localized workforce. Honestly, that often sounds like corporate PR spin for, we hired some local contractors.
Right, it's a buzzword.
Exactly.
Yeah.
So how does that actually translate to a $72 million revenue beat? Was this purely about having the physical assets in place early, or did competitors effectively hand NESR market share on a silver platter by pulling out?
It translates precisely because of risk matrices, and it's really a combination of both. Having the iron ready to deploy is table stakes. You have to have the equipment. But the market share gains came directly from their posture during the geopolitical unrest.
Explain that.
Well, think about it. If you are a massive, global, big 3 oil field services company based in Houston or Europe, and a conflict kicks off in the Middle East, your corporate insurance policies and headquarters safety protocols automatically trigger alerts.
Right. The multinational risk management protocols kick in.
Exactly. They physically have to pull their expatriate engineers out, they evacuate personnel, or at the very least, they pull back operations significantly to assess the risk.
While those international players were sounding alarms, NESR leaned entirely on its localized workforce.
Yes, they explicitly highlighted this on the call, 100% operational continuity, 0 evacuations.
So wait, operations for the big multinationals just halt. The national oil company is sitting there with a well that needs stimulating, and the global provider is effectively paralyzed by their own corporate HR and insurance policies.
Precisely. And when a national oil company needs a well stimulated, they cannot wait weeks for a global service provider's risk committee in Houston to decide if the region is safe. NESR was already there. Their employees actually live in these communities.
Right, they aren't expats.
Exactly. They have completely different risk matrices and deep local supply chains. They simply did not leave. That localized resilience allowed them to instantly scoop up the work from those fleeing competitors.
That structural advantage of being a quote-unquote national champion
Right.
rather than a visiting multinational really shows up in the reliability metrics.
It's a huge moat.
But look, top-line beats are completely irrelevant if the costs of navigating a geopolitical crisis eat all the profits. A company can generate $1 billion in revenue, but if they spend $1,001 to get it, the equity is worthless.
Very true.
So we really need to look at how NESR managed their margins and cash flow amidst all this regional chaos.
Which is where the financials get very interesting. Adjusted EBITDA hit a record $106.2 million. That is a 20.4% margin.
Over 20% margin in this environment is incredibly strong.
Yeah.
They noted that benefited from high utilization, which makes total sense if they are scooping up everyone else's work and some seasonal improvements.
Right.
But here's the critical line item I want to focus on. Those margins absorbed a $4 million hit. That is roughly 80 basis points of margin compression stemming directly from incremental freight and logistics costs. We are talking about special air freight charters to ensure zero service interruptions.
Yeah, chartering heavy transport planes to move oil field equipment is incredibly expensive.
Right, and $4 million isn't a small premium. Let me stop you there and ask directly.
Yeah.
Is this $4 million air freight premium a one-off heroic measure to save the quarter? Or are we looking at a recurring tax on operating in the MENA region right now?
That's the million-dollar question.
Because if you are modeling this company, a recurring 80 basis point margin penalty is a big deal.
It is a phenomenal question, and it speaks directly to the quality of these earnings. Management addressed this head-on, and they do not view this as a prominent spiraling tax. They proactively plan for these costs via their 30, 60, 90-day contingency inventory strategy.
What does that actually look like in practice?
It means they deliberately over-index on critical inventory based on a rolling 30, 60, and 90-day forward-looking schedule.
Ah, I see.
Yeah, they effectively pre-positioned critical materials to avoid the exact supply chain bottlenecks that choke their competitors. The CFO noted they do not expect freight costs to exceed this Q2 level going forward unless the geopolitical situation deteriorates materially.
So it was a planned buffer.
Exactly. It was the calculated price of maintaining that 100% operational continuity we just talked about. And frankly, if you think about capital efficiency, paying $4 million in emergency air freight to secure a $72 million revenue beat and permanently capture market share from retreating competitors is a spectacular return on investment.
Oh, absolutely. When you contextualize it like that, the $4 million isn't a tax at all. It's an acquisition cost for new market share.
That's a great way to put it.
And you see that efficiency clearly in the cash flow metrics. Operating cash flow was massive at $174 million. Free cash flow hit $99.9 million for the quarter.
Though, we should probably clarify the normalization on that free cash flow number for the listeners.
Yes. Management was very transparent here. They noted that this $99.9 million free cash flow figure normalizes to about $60 million after you account for a $40 million timing difference in supplier payments.
Right, just a calendar thing.
Basically, yeah.
Right.
These were outbound payments for inventory that happened to settle just days into the third quarter instead of before the Q2 cutoff. But even at $60 million normalized, this business is a cash machine right now.
It really is. We saw their days sales outstanding, or DSO, drop to a record low for a non-year-end period.
Meaning they are collecting cash from their clients faster than ever.
Exactly. And that rapid cash conversion allowed their net debt to adjusted EBITDA ratio to plunge to 0.3x.
0.3x. If you were looking at NESR's balance sheet right now, you might be wondering why a 0.3x leverage ratio matters so much in this specific sector. For an oilfield services company operating in a heavy CapEx growth phase, buying frac fleets, building out regional infrastructure, a 0.3x ratio is virtually unheard of.
It's incredibly lean.
Their stated target is to stay below 1x. So sitting at 0.3x gives them incredible flexibility. Net debt dropped to just $99.6 million.
And tying all that capital efficiency together, their trailing 12-month return on capital employed, or ROCE, reached 13.5%.
That's a great metric to track.
It is. For those tracking this, ROCE essentially measures how well a company turns its heavy iron and capital investments into actual operating profit. Hitting 13.5% tells you that the massive capital they are deploying, like those frac fleets in Jafurah, is generating highly accretive returns. They are not just growing revenue for the sake of revenue, they are growing profitably.
Which perfectly sets up their new capital allocation framework. With the balance sheet this pristine, they announced a new $1.10 quarterly dividend starting in Q4 2026. On top of that, they authorized a $50 million share repurchase program.
That dividend initiation is the ultimate signal of management confidence to retail and institutional investors alike. You simply do not initiate a recurring, permanent quarterly dividend if your executive team believes your current cash flow is just a temporary geopolitical spike. It means they are entirely self-funding their massive expansion while simultaneously returning capital to shareholders.
Okay, here's where it gets really interesting. Now that the balance sheet is secured, debt is virtually non-existent, and capital is being returned to shareholders. How is management deploying the remaining cash to hit their future growth targets? Management introduced this 3v3 strategy.
Yes, the 3v3 strategy aims to hit a $3 billion revenue run rate within 3 years. And CEO Sharif Foda actually noted on the call that given the current trajectory, they might hit this target even faster than planned.
A major catalyst for this acceleration, and something that really jumped out to me in the sources, is Kuwait's Ahmadi Innovation Valley, or AIV. NESR was just named an inaugural partner in this new master technology agreement.
This is a huge deal for them.
Right. Because if you look at the traditional oil field tender process, it is famously agonizing. Imagine you invent a game-changing downhole tool. To commercialize it historically, you have to go through months, sometimes years, of committee reviews, pilot programs, trial runs, and bureaucratic tender bidding before you see a single dollar of revenue.
It is a massive barrier to entry for new technology.
Exactly. But from what I am reading in the transcripts, this AIV framework in Kuwait acts like a VIP fast pass at a theme park. It allows NESR to immediately deploy fit-for-purpose technology and generate revenue instantly, completely bypassing that sluggish tender line.
If we connect this to the bigger picture, that AIV agreement fundamentally alters the valuation multiples you can assign to this company's technology portfolio. You described the agony of the traditional tender process perfectly. The Kuwait AIV agreement shatters that timeline.
It's a total paradigm shift.
It allows NESR to take their frontier growth ventures and essentially plug and play them into the Kuwaiti market.
What kind of technology are we talking about here?
Things like downhole water separation. In traditional wells, you pump up a mixture of oil and water and then spend massive amounts of energy and money separating the water at the surface.
Which is terribly inefficient.
Right. Downhole separation tech separates the water at the bottom of the well, keeping it underground and only pumping up the oil. It is revolutionary for efficiency. Under the AIV, NESR can take this tech along with Roya, which is their advanced directional drilling platform, or NEDA, their decarbonization and minerals initiative, and deploy it directly.
Wow.
If tech works, the national oil company pays for it immediately. It shifts their commercialization timeline from years to literally months.
And that rapid monetization is exactly how you accelerate a path to a $3 billion run rate. They don't have to wait until 2028 to see revenue from R&D they are finishing today.
Exactly.
They're also looking at geographic expansion to feed that 3B3 funnel. Syria was highlighted in the call as a promising new anchor market. Management pointed out that international oil companies, the IOCs, like ConocoPhillips, Total, and Qatar Energy, are beginning to revive the country's oil and gas industry.
And NESR believes they have the blueprint to support these IOCs and the national oil companies in these re-emerging basins. I mean, they have proven they can operate in high-friction environments.
They certainly have. But let's take a step back and apply some friction of our own. A $3 billion target and a 23% single-day stock jump indicate a lot of market euphoria. We have to look at the structural risks hiding in this print. The primary risk, obviously, remains geopolitical tension, disrupting logistics, and delaying those big tender awards.
Yes, and management was very upfront about this. They noted that a $3 billion pipeline of tender awards is currently being pushed from Q2 out to Q3 and Q4 of 2026.
Okay, so a delay.
Right. The national oil companies across the region are currently prioritizing production recovery and stabilization over issuing new, massive, long-term awards.
Which sounds incredibly bearish on the surface. If $3 billion in contracts is getting delayed, that usually signals a slowdown. But there's a massive nuance here regarding how these clients are treating their drilling rigs.
A very important nuance.
Rigs in the region are not being cold stacked. They're being warm stacked. Clients are managing production by holding off on drilling the reservoir sections, but they are keeping the supply chain ecosystem totally intact. Which leads to this phrase CEO Shiri Fota used that I really want to dig into, the post-conflict box of restart opportunities.
This raises an important question about how energy markets actually function during a regional crisis. It all comes down to the mechanical difference between a rig being cold stacked versus warm stacked.
Right, and if you're looking at standard industry practices, cold stacking a rig essentially means putting it into deep hibernation. You fire the crew, you power down all the equipment, you lock the doors, and you walk away.
It's completely offline.
Exactly. Bringing that rig back online takes months of logistical planning and millions of dollars in startup costs.
It's a logistical nightmare to restart a cold stacked rig. But what NESR is seeing in the Middle East right now is that the national oil companies are intentionally warm stacking their rigs.
Meaning the engines are still running.
The engines are running, the crew is still on the payroll, the lights are on. The clients are intentionally paying millions of dollars a week just to keep this ecosystem alive.
Why do that?
They are doing this so that the literal second the geopolitical tensions ease, say, the export routes through the Strait of Hormuz fully clear and maritime insurance rates drop, they can flip a switch and instantly ramp up production to capture global market share.
But wait, you can't just flip a switch, can you? An oil well isn't a kitchen faucet. You can't just turn a valve and expect a well that has been sitting idle to produce optimally.
And that is exactly what FOTA's post-conflict box refers to. You are right, it is not a faucet. To turn a warm-stacked well back into a high-producing well, you need immediate, highly specialized mechanical intervention.
This is where the heavy jargon comes in, things like coiled tubing, slick line, and workovers. For those of you who don't spend your weekends reading drilling manuals, think of slick line like a massive, heavy-duty fishing wire.
That's a good analogy.
It allows engineers to lower specialized tools thousands of feet down directly into a wellbore without having to painstakingly pull out miles and miles of heavy steel pipe. It is fast, it is precise, and it is absolutely essential for maintenance.
Precisely. And coiled tubing operates on a similar principle, unspooling a continuous length of pipe down the well to perform chemical treatments or clear out debris. You need those specific tools to go down into the wellbore, clear out temporary plugs, stimulate the rock, and perform workovers to get the oil flowing freely again.
So they're waiting for the green light.
Exactly.
Yeah.
NESR is deliberately parking its idle slick line and coiled tubing assets right next to these warm-stacked rigs to capture that exact, violent snapback in activity. The $3 billion tender pipeline hasn't disappeared. It is just compressed like a spring, waiting for the geopolitical green light.
Okay, so to give you a rapid-fire summary of exactly what went down this quarter, NESR leveraged an aggressive pre-planned inventory build and a deeply localized workforce to completely absorb regional geopolitical shocks.
Seamlessly.
That operational resilience translated directly into scooped-up market share from paralyzed competitors. That led to a massive top and bottom line beat, a raised $2 billion minimum revenue floor for 2026, and the financial strength to initiate a brand new quarterly dividend while paying down debt to near zero levels.
Exactly. They proved that their model of being a localized national champion is not just a marketing slogan. It is a highly defensible, highly profitable operational moat in times of crisis. When the dust settles, they are the ones holding the contracts.
Which leaves us with this provocative thought to consider. NESR's entire success this quarter was built on refusing to evacuate, sourcing locally, and maintaining 100% operational continuity while their international peers blinked.
They held the line.
They did. Will this staggering financial outperformance force the global Big Three oilfield service giants to completely restructure their own Middle East supply chains and labor models? Because if they don't, they are going to keep losing market share to the resilience of a regional champion every time tensions flare.
It's a massive strategic dilemma for the big players.
It is a structural shift in the energy sector worth watching very closely. Make sure you follow the show for daily, no-nonsense earnings coverage right here.